What's happening, guys? Welcome back to another Sunday Scan. We've had a very eventful weekend. There's been a lot of, global kind of macro developments, things with Iran and how that might spill over into the oil market and a bunch of other things. So in order to really, break down a lot of these moves and how they're going to impact the markets, we have a special guest today. We have Steve Place. He's an incredible trader. He focuses a lot on options, global macro, and then also equities as well. So basically, we'll break down some of these moves, how they will spill into the equity markets and the options markets. And then we'll have several names on watch for people to kind of keep on the radar for the week ahead. But Steve's just a great person that covers so many aspects of different markets. So I promise you'll want to watch until the end because we'll tie it all together. We'll cover everything from the recent moves in Circle and CoreWeave to the oil markets to things with Coinbase, Robinhood, and Visa, MasterCard. So just a very wide range of stocks that we will cover in the episode ahead. So make sure that you stay until the end. A couple things before we get into the episode. Traders for a Cause has their upcoming regional event in San Diego, July 17th. So if you're interested in that, make sure that you pick up some tickets. You're going to have some great traders there like Lance and Kyle and some others. So if you're interested in that, make sure that you pick up your tickets. And then before we bring on Steve, I'll just give the disclaimer now that neither of us are financial advisors, and this is not buy or sell recommendations. All this is for informational and educational purposes only. Now let's get into Sunday Scan with Steve Place. All right, we're very happy to have Steve Place on Sunday Scan this week. Steve, welcome to the show.
What's going on, my friend?
Yeah, we have a lot to talk about, and we really want to get your thoughts on the market. There's been so much happening. There's things that could potentially, be triggering some volatility. There's things in the oil markets, a lot of different markets that you kind of track. So to kick things off, we heard about the strikes on Iran this weekend. So that could have a lot of knock-on effects. So what are your general thoughts about how that could really spill into the market? And what are you watching with that?
Okay. So first off, whenever a weekend news story like this breaks, because the markets aren't open, everyone's already panicking, right? And it's just a psychological thing. There's a lot of recency bias. What I like to do is I go onto a site called Weekend Wall Street, and these are CFDs, contract for differences, that trade over the weekend. And right now, the market, if we were to have a market open, we're down about 1%. So we're currently not seeing a crash. I know that there's this running joke with traders that every time some new current event happens, we become an expert in it. And, you can get like 80% there. So I do have some maps that we can look at. We can briefly touch on geopolitics, and then we'll get into some charts with respect to crude oil and sort of some hypos that we can walk through on the broad markets. How's that sound?
Sure. Yeah, let's pull up some charts and then we'll go through, because I know that there's been chatter about them closing the Strait of Hormuz and some other things like that. So I'm curious to see what you have lined up.
All right. So here's our map. Just in terms of geopolitics, if you want to be the reserve currency, you have to have the strongest Navy in the world. The U.S. does. We've got nuclear submarines stationed everywhere, so we still win. But these are the big choke points. These are where all the maritime trade goes through. So we've got Panama Canal, and the U.S. just recently locked that back up again. You've got the Bosphorus Strait in Turkey, the Suez Canal, which there's actually some second order effects because of the Houthis, which were locking down the Red Sea. When you can't push things through the Suez Canal, then Egypt loses a significant portion of that revenue. And then there's some things that could happen after that. You've got the Strait of Hormuz that everyone's talking about, and that's the big one. And then you've got Strait of Malacca, Strait of Taiwan, and Taiwan's China. So these are all the big choke points in geopolitics. That's what militaries are obsessing about. So the U.S. carried out 3 strikes on nuclear facilities. It seems to be, at the time, very limited in scope. They're basically saying we have total air superiority. You can't touch us. There's nothing you can do about it. And so why don't you come to the table and negotiate? That's the current narrative that's going through. Now, the Iranian parliament is now saying we're going to shut down the Strait of Hormuz, which could lead to what's the second order effects there? Oil prices go up. which can impede margins on basically everything, because everything's downstream from energy prices. If that happens, the markets could just react a little bit to the downside. We also have one more thing, and I think this is important for everyone to know, and then we'll leave it here. These are the two pipelines that are trying to get built. And so when you talk about the Syrian civil war and everything else that's been going on, this is downstream of everything. So Iran wants to build a pipeline up through Iran, through Iraq, through Syria to get access to the Mediterranean. The US and the Saudis want to go through Qatar, through Saudi, up through Jordan, up through Syria, and through Turkey. And so these are the battle lines that have been drawn in the Middle East effectively. And you can see, these are the two poles, and everything that's been going on over the past, you could reduce this down for the past decade and say this is the play that everyone's focused on. So, I have a negative expectancy when actually trading geopolitics. So what I try and do is say, what's the kind of hypotheticals that we can deal with? So I'm going to be focused on crude oil futures, and I'm going to be focused on equities. So right now this is a chart of CL, and I've got a couple yellow lines on here. And these are the 1-day volume weighted average prices for some of the key catalyst days that we saw starting on Friday, 2 Fridays ago, and then through last week. And so they're sitting right around $73 and $74. And that's my over-under zone. The longer that crude holds above this level, the higher the odds that we see a push. But if crude manages to take out those levels to the downside and then maybe retrace, hold, and roll over, then that should be it. All right, so that's my basic over-under. That way I don't have to think about all of the geopolitics stuff in the middle of the trading day. A lot of people, when we have news like this, there's declarative and then normative. It's like, here are things that are, but everyone's trying to trade on things they think should happen rather than what is happening. So try your best to put your blinders on, figure out your levels. And it's not about the levels themselves. It's about the reaction around those levels. So if the market, if crude oil gets hot and continues to rip, and maybe it pulls back to 73, 74 and it still holds, then energy's still in play. But if this is a parabolic spike, and you can back this out, we are coming into larger resistance in the crude oil market, 77, 78, that's just going to be a tough place to get over unless the narrative shift that we have had has changed liquidity structure in crude oil to the point that we just bust out above it. But we don't know yet. So the hypo in crude is basically based off of those over under levels. I wouldn't be shocked if we're probably going to see a gap up in crude. If we break above 80, things could probably get weird in the equities market. If we continue to hold, and then it's just one of those nothing ever happens kind of trades, then I would suspect you get some profit taking in oil, and then we probably see another pop in equities. So that's kind of my thoughts there with respect to equities on their own. And if any of this starts to get confusing, man, just let me know, because we're about to jump off the deep end with some options stuff.
No, I think it's great. And I think just to, clarify a few points too, of, why this really spills over into the equity markets. The Strait of Hormuz that you mentioned, about a quarter of the oil production of the world passes through there. And so if that's shut down, that has knock-on effects. That affects, things that spill into the small cap oil market, which you have these speculative crappy names that have already been in play, possibly coming back more into play. You have things, knock-on effects with large caps like EQT, more the liquefied natural gas. You have XOM, and then you have the shipping angle, which is FRO, ZIM, where it's shipping rates can really spike if some of those things happen. So we're not just talking about these things just to talk about them. They all have knock-on effects that spill into markets, and that's what makes sectors come into play. And so that basically increases volatility, increases volume and range, And that's why we care about those things. So great points with all that, Steve.
What are some of those DGen small cap oil names you like to trade? So HUSA is one of them, right?
So yeah, HUSA, INDO, we've had RBNE recently, and then a few others. And basically what tends to happen with these is that you have, some kind of event trigger something in crude oil, and then you basically have the ecosystem of the oil names. So you have the large names like the XOMs, the Chevrons, things like that. You have the EQT, which are the liquefied natural gas plays, and those can basically start to discount higher margins due to higher prices. And then you have the more speculative, the degenerate stuff in small cap land, where you have these companies that barely make any money. They'll put out a press release, they'll attach themselves to the oil market, get a huge spike, and then because everyone knows that they're crappy, they become heavily shorted. And then it's just a process of basically squeeze outs and then reversions back down. And so depending on the headlines, that really tends to drive the small caps.
So the most interesting point, have we been talking this entire time without me sharing charts?
No, I just took on.
Okay. All right, cool. I was just making sure.
Yeah.
The interesting thing about HUSA is they just had a reverse split. So there's not a lot of shares. It was a 1-to-10 reverse split, and they just got a really good timing move with the Iranian mess. So yeah, that one's probably going to be in play pre-market, and we'll see if that squeezes. So let's talk about the broad markets. There's been a persistent wall of worry in. Let's take the levels off. There's been a persistent wall of worry in the S&P 500 since April. And that wall of worry, market rallies, everyone's selling, but it just continues to auction higher because there's no one left to sell anymore. But it's also very true with respect to how the options market is positioning. Now, we did just get through June monthly OPEX. So a lot of hedges got cleared off the board, which could introduce a little extra downside convexity. But it's a really tough trade right now. And here's why. Here's the advanced stuff. You ready? This is a chart of the volatility term structure in the VIX futures market. So the way vol works is that we have markets based off of the expectation of what volatility is going to do. And I don't believe that volatility is even the right word. We're actually looking at liquidity. So if the markets limit down and there's no bids, there's no liquidity, the VIX is going to be at 80, right? If the bids are very thick and there's not a whole lot going on and there's tight ranges, then this will eventually start to go lower. So the spot VIX is currently trading at 20, and the July VIX is currently trading at 21. So what does that actually mean? That means based off of this pricing, the people who are buying hedges are buying at a vol of 20. And there's a very simple calculation you do. You just divide that number by the square root of 252. There's 252 trading days in a year. And that gives you the expected daily range. And that's about a 1.3% daily move. That's what should be happening 2/3 of the time in the market if this was correct, if it was equally priced in, where it was 1-to-1 tracking the actual volatility of the market. But we're not seeing 1.3% daily moves. We're seeing much less. The realized or the historical volatility, this yellow line down here, is currently sitting around 12, right? So there's a very wide gap between the market pricing in the risk and what has actually been happening over the past month. A lot of people have been buying hedges. They're still sketched out about trade war stuff. They're still sketched out about Iranian stuff. And if everyone and their mother's hedged, it's difficult for the market to go lower because you don't have that sensitivity, that fragility to the downside. And it's difficult for me to be super bearish on this market. Like, we're still trading above the 20 EMA. We haven't even broken under it yet. And if everyone's hedged, then what happens when we see a sell-off? Well, people start selling their hedges off. The market makers end up net short because they're taking the other side of those, or they're ending up net long, but there's a mechanic where it actually puts in a floor in the market. All right, so that's just from a volatility and options perspective. Unless we start seeing, 2% gaps right? Both to the downside and upside, then it's difficult to justify what's been going on in the options market. And it's one of those like, think about how people were positioned into late April. They're saying, oh shit, there's going to be a retest of the lows, right? So you don't want to buy weekly options because that's too degen. So you go out to May or June or maybe July and you start buying some puts. Well, a lot of those puts are still on the books and they're all getting cooked. They're getting decayed. Into pullbacks, you're going to have people saying, well, these hedges didn't really work, but I can at least, they were all at a full loss, but now I can get out of 50% loss, or maybe I can get out at break even. And that puts a floor in the market, right? That's not necessarily what I want to happen, but that is just what is set up in the market right now. So just like crude oil, we've got our over-under levels, 73, 74 bucks. If the S&P 500 is moving less than 2% a day for, let's just say, the next 3 days or so, we're probably going to go higher. That's just how it's structured right now. That's just how it's set up. Now, when it like 35% of the S&P is in those Mag 7 stocks, some of them kind of look not good, right? As an example, Google's starting to break some downtrends. It's starting to roll over. Apple still looks like garbage. It might bounce. Microsoft, it's had a nice rally, but it could revert. So in aggregate, if those large cap tech stocks do manage to find some sellers, that's probably where the pocket of weakness is going to be. But that's not what's been moving. There are names underneath the surface. There have been stealth rallies. If you've been a passive investor just owning the NASDAQ, you haven't participated. Right? There's been so many names with quality setups that are seeing follow through without a whole lot of heat back to the downside. Until that mechanic changes, then it's still game on in the risk markets. I'll give you, CoreWeave. Everyone's watching Circle, and we could talk about Circle, but CoreWeave this past week had this midday spike with volume back on Tuesday, and it continued to hold. Right? Until these kinds of mechanics stop working, we have to assume that momentum's still on, fund managers are still playing catch up, and these high beta stocks are still ready to rip.
Yeah, and we've really seen that, especially with the recent IPOs. So obviously CRWV, we have CRCL, and really, one of the structural things about recent IPOs is that they're subject to lockup periods, and so although you have very extended moves, in some regards, you also have extremely limited supply. You have, the ability to short these. So they're very short, crowded. There is some options influence, even though it might not be the main driver. And there's just a lot going. So when I see exceptional structures, exceptionally low, floats, exceptionally high volatility, it's due to these, exceptional circumstances. So do you have any other thoughts on kind of CoreWeave, Circle, what you're seeing, what some of the expected moves could be, or any setups within that?
So I don't have my options software up. If you see a gamma squeeze, what tends to happen is that the out of the money calls maintain value as time gets closer to options expiration. So what's happening there is that the premium, the time premium, is being replaced by volatility premium. And that can give you an early signal saying, you know what, things are getting sticky. Option dealers and market makers are probably on the wrong foot again, and that can continue to squeeze. So if, for example, Circle were to see a large range expansion to the upside again, because everyone's saying there's no way in hell Circle's going to break and hold above 250, which, the market gods will descend upon us and show us exactly how that can happen, right? So if we get another range expansion, and there is evidence of a gamma squeeze with a lot of option volume coming in, starting around Wednesday or Thursday, that's when you want to start looking short. There's a mechanic called a Vanna unwind. We saw it a couple times in CoreWeave. They weren't very, very fat pitch kinds of setups. We saw it in APLD as well. There is a trade structure here that, if you want to participate in the short side but have a little bit of a kicker, you can look at some weekly options, and you want to go pretty close to at the money. And then you go about a month out, and then you sell some out of the money puts. And it's a goofy looking structure, But what tends to happen in these names as they sell off, implied volatility actually starts to come out. So you get benefits where if you do actually manage to nail the top and have perfect timing, those options you own all go in the money, and then there's no volatility anymore because it's all intrinsic value. But then those puts that you sell, they do lose some money on the directional exposure, but they actually start carving that back due to some of the premium being taken out because everyone starts selling those puts into the first pullback. So that's kind of the structure that I'm looking at. It does require some margin. Circle's a $200 stock, so if you want to do any size, it's kind of tough to do. But yeah, that's what I'm looking at there. I think a lot of eyeballs are going to be on Circle. It may be a tougher trade. There's probably going to be some traps. There's probably going to be a lot of games being played. And you might want to start looking at some of the others, either looking for potential parabolic fades. And I think CoreWeave could be a better setup than trying to focus on Circle, where, if it clears 186, 187, but fails to hold above it, that's a bit of a signal. But the other thing you could start looking at is some of those other recent IPOs that haven't had their moves recently that could be setting up as well. So I think, what's the one on the list? Was Galaxy an IPO recent? No, it wasn't. I'm trying to think of the other one off the top of my head, but I'm going to have a huge brain fart on it. Let me just give you some examples of just some of the momentum stocks that I think are going to work then. Back to the upside. HIMS, right? I think HIMS is ready to go. And this one hasn't held above 63 basically this entire time. If it manages to clear and hold above 63, it's probably running to $80, right? So that's I think Tempest AI could be another one like that, where it's tried to get above 72, 75. It hasn't yet. Maybe we just see some hot money rotation into this one, right? This is a recent IPO, and it hasn't had that extra push just yet. And so there's other, you don't necessarily have to trade Circle. There are other recent IPOs and other hot money stocks that could see the money rotate back into them while Circle squeezes out that last bit and then starts to roll back over. Does that make sense?
Yeah, it makes perfect sense. Okay. And then if we could go back to just one of the concepts that you touched on a little bit with Circle and CoreWeave. So, talking about like basically Vanna, and then maybe you could touch on Charm a little bit as well. So basically looking for reversion trades on things that are very options driven. We talk about waiting for those, Thursday, Fridays, basically when you have, Lance talks a lot about the right side of the V. And the way that I conceptualize this, it's like the right side of the options V. So like the right side of the IV, if you will. So basically, as options driven names, as they have kind of gamma activity going up the chain, that out of the money call options, they increase in vol, they increase in, basically value. And then they get to a tipping point where they start to revert, as we get closer to decay, and those unwind, and then the hedges unwind. So can you talk about what you really look for? Are you looking for, specific flow associated with those options moves, or just how are you thinking about those reversion trades and the associated Greeks?
So I'm not thinking about flow and looking for large call option blocks. What I'm looking for is you've got to see a lot of volume come into these names in the options market. So let me give you an example. This is Circle. The current volume on Friday was 92 million shares that were totally traded. I don't know how many shares are available to be traded. I wouldn't be surprised if we're trading a multiple of that now. But what I'm looking at is the open interest on higher strike prices. And it has to be a lot, right? You can't just have 20,000 contracts trading. So here's some simple math. You go out and you look at a 30 delta weekly option. All right. So that's for Circle, it's probably going to be around 260, maybe 270. And you want to look at how many contracts are currently sitting at that strike price. Now, not all of them were bought to open. All right. Some of them were sold. But if you just assume that they were bought, let's just say there was just one. We'll just start with one. It's like Willy Wonka, where it's like, I've got 10 chocolate bars. You mean 10,000? No, just 10. We'll try and keep it simple. If you have a single 30 delta call that's out of the money and then it goes to at the money, that delta, the directional exposure in that option went from 30 shares to 50 shares. That means it was a 20 share change. So if a dealer is on the other side and they're net short that call, they have to buy 20 shares of stock to get back to flat. They don't want to have a whole lot of directional exposure. So if you have 10,000 contracts that go from a 30 delta to 50 delta, that is a directional exposure change of 200,000 shares. Right? That could be a lot. Like if you look at the bid ask size on Circle on an intraday, you look at the level 2 and it's like, how are these people going to put 200,000 shares of delta out into the market without significantly raising the price? Now, if the ask, if the people that are selling, if it's super thick and they can get away with it, then you're not going to see a whole lot of price movement to the upside. So the volume in the options market is going to matter the most. You have to look at the open interest, the total amount of exposure that actually carried over into the next day, and then just kind of figure out, is that enough to move the needle? Is it enough for the tail to wag the dog rather than the other way around? I didn't really see it in Circle this past week. There wasn't a whole lot of options out there, but maybe if there's not a lot of shares that's currently available, it's enough to move the needle. So you can go out and you can look at this upcoming week's options chain for Circle. Look at maybe the 260, 270 calls. If there's 100,000 contracts that are in the open interest, that sucker's going to jam higher, right? It's just going to be a magnet because we're trying to frustrate and stop out as many people as possible. I don't, the way that gamma squeezes have evolved, everyone remembers GameStop. We don't have GameStops anymore because the dealers are out in other durations buying exposure out there just to make sure they don't get run over like that. So it's not, I don't think it's going to be as extreme as we've seen in the past, but that's the mechanic I'm looking for. Is there enough options liquidity demand to overwhelm the stock liquidity supply? And that usually starts to unwind into Wednesday or Thursday, because the delta change that we just talked about, where it goes from 30 delta to 50 delta, that's called gamma. But if you have an out of the money option that's at 30 delta, at expiration, it's at 0 delta. So as we get closer to expiration, the dealers actually start to unwind their position, right? And then they start selling. And then if the selling liquidity demand from the options market overwhelms a stock's liquidity supply on the bid, that's how you get those nasty unwinds. It's clear as mud, right?
Yeah, and that was a fantastic explanation of that. Okay. And I think that that's what a lot of people have been seeing in some of these reversion trades, but they haven't been able to put some of the mechanics to that. So going to another part of the market, I want to pull up basically a few things here, associated with some of the CRCL and some of the things that we've seen with Coinbase, where basically they passed the new Crypto Act. And, basically there's some narrative change about, maybe the traditional names like MasterCard and Visa being a little bit dethroned and, controlling all the payment rails, as places like, Coin might be stepping into some of those roles. Has that been something on your radar? And then also, as a tag onto that, could you just quickly share your framework for how you really think that narrative drives liquidity, which drives markets? Okay.
You leave your chart up. I'm going to try and pull up some slides because I actually do have a framework for this. So the federal government thought a lot about this. The federal government this year had $9 trillion of debt to roll over. And at the beginning of the year, everyone was really freaking out about it, saying, oh shit, what are we going to do? Who's going to be the new marginal buyer, especially into tariffs and trade wars, where there is sort of this implicit mandate from the Fed saying, you guys got to stop stockpiling dollars when we buy stuff from you, right? Because it's not tariffs, it's trade balances. And so if those marginal buyers go away for US treasuries, who's going to step in? And it turns out it's stable coins, because Circle has something like $70 billion in USDC. Tether's got $155 billion. And guess what? Like that, they are the new marginal buyer. And there was actually a tweet coming out from Scott Bessent this past week saying, hey, stable coins are actually a very big deal for us. So I'm going to try and pull up some slides really quick to explain this. So it's not just Circle. It's not just Tether. We're going to see, I think, Walmart has announced a stable coin potentially. Amazon's announced a stable coin. I wouldn't be shocked if Shopify got into the game. I wouldn't be shocked if we actually see some of the major oil plays that sell oil create a stable coin indexed off of a gallon of gas. And those are the new ledgers. The old ledgers like Visa and MasterCard, I think, are smoked because they're really expensive blockchains now. They are legacy blockchains, if we want to reduce it like that, they cost a lot, very high merchant fees. I understand that they have to defend against fraud and stuff like that. But I'll tell you what, as soon as Coinbase opens up an airport lounge, bro, it's game over for American Express. Like if you can get into LaGuardia and you've just got a bunch of crypto bros vibing, right, in some first class lounge for all the Coinbase whales, who wants to own an AXP card anymore? So that's kind of how I'm thinking about this. So yeah, I am in terms of a narrative, I'm structurally bearish on some of these larger extractive TradFi companies. Okay, so that's kind of where I'm sitting with that. So I managed to, while I was talking through that, find the slide I was looking for. So this is my clean model. This is CLN. So there are things that drive price. The only thing that actually drives price is liquidity, and the liquidity changes on both the demand and the supply side. But there is a reflexivity in this market where narrative changes can drive liquidity changes. But then it can go the other way too, where if a stock gaps down, then people get bearish on it and they look for reasons in a narrative. And sometimes you have those catalysts that could be an earnings or an FDA event. So all of these things, I don't just look at charts. I think about context and how that context can end up affecting price. So I'm not buying a stock because I think the price to earnings ratio looks good. I'm buying a stock because I think institutions will think the price to earnings ratio looks good and will become new marginal buyers that jam the stock higher. So there's just one extra level of abstraction that you need to have. And this works on, intraday degen, low float, small caps. And it also works on Apple, right? So it's not just about the story, it's whether the story can affect the liquidity of the market. Does that make sense?
100%. And we see this, in small caps, large caps, all over the place, where a perfect example with some of the small cap oil names, they release a headline basically tapping into some kind of a narrative, and that can drive liquidity to them. And then, that price action attracts, all kinds of buyers and sellers. And you just have this vicious feedback loop until usually there's some kind of dilution or until the narrative changes. And then you have that reflexive process extracting the price instead of inflating it.
And sometimes the narrative isn't even about the stock, it's about the structure. So everyone's like, oh, this stock's going to go because of a gamma squeeze. And then everyone starts believing it to the point that the stock rallies, or everyone's anticipating a short squeeze. But then you can take the flip side and say, all right, if everyone's looking for the short squeeze and it doesn't hit, then it's probably going to get killed, because then it just trapped all the buyers who were trying to buy in anticipation of the short squeeze, right? It's just turtles all the way down, man.
Yep, 100%. That's something Nate talks about a lot, where, usually the turning point for when, either reversions happen. So whether it's like a short squeeze or some stock that's going parabolic, when that is ready to revert, or when it's something that's been crazy, sold off, super low, basically when doubters become believers, that is the turning point. When you basically get everyone on the same side and then price starts doing the opposite thing, then you have those unwinds. So when everyone's saying, oh, there's no way that Circle can go higher and everything, and then it goes to 300, now everyone's like, I don't even want to participate. This thing's going, even higher. Then it usually can be the tipping point. And the same thing when something's going to the lows.
So let me give you an example that I think is one of those price narrative cycles that's going on. So we have Uber, and Tesla is rolling out their robotaxi, which is technically a competitor to Uber, right? And Uber has a very big pivot level, right around $82. Oh, I already have it listed. There we go. It's got that pivot level right around $82. And if the stock breaks down underneath it, but then fails to roll over and actually pushes back above some kind of a failed breakdown setup into the robotaxi rollout news, that's a very good long setup in Uber because the price action is running contrary to the prevalent narrative that's going on. Right. So that's one I'm looking at right now where I could see it breaking down. Right. But that's kind of the obvious trade. I think that's the rookie trade. And we want to see something where if the stock knifes lower and within 30 minutes to an hour gets back above that, especially on the open, it's probably going back to $90. And then the 90 calls are going to be cheap because no one wants to buy them.
Yeah, great observation there. And then also another name that kind of comes to mind, not necessarily, on that narrative, but on, again, the crypto narrative and everything is Hood has really held very well. And this looks like one that, it reminds me a little bit of kind of the Palantir moves. And, it's just really, if you look on multiple time frames, this reminds me of when Palantir was maybe, in the 40s or the 50s, kind of coming back up to those 2021 levels. And, it's just been super strong. And I think if it clears some of those levels, then, it does look like it has some more upside, especially as it's tapping into some of those new narratives with the stable coins and everything like that.
Yeah. And like with Hood, think like I'm not involved. I'm looking in this chart and I'm saying, man, I'd love a pullback. And the pullback just keeps not happening. Right. And that in and of itself can be a signal where it's like, okay, it hasn't even gotten close to touching the 20 EMA since it's rallied. Every bid, every knife lower has been bid up by someone, and it just continues to be sticky. And so, it's one of those where the rate of change could just increase in the short term. I haven't looked at the options recently, but yeah, you're absolutely right on that.
Yeah, that's a great one. And that's someone like Ariel. He's been all over a lot of these names that just they're showing relative strength in the market, regardless of what's going on with oil or, the headlines. These names that are just consistently, they look like they're going to break down. They immediately soak up, and those dips along the way, even though that they're, small. Like we had a couple over here, and that was around when everyone thought it was going to get added to the S&P index, and it did not. It ended up having a nice little gap down, but again, it could barely get above any kind of recent range get below any kind of recent range levels and just immediately soaked back up. So that's a sign that there is, institutional buying and, you can see it's above all moving averages and, just a very clean chart pattern to the upside. And then Steve, one of the last things I really wanted to touch on is, do you follow the gold market at all along with oil, or is it more just when it's in play?
When it comes to geopolitics, I'm not going to try and anticipate gold with that. Gold will have moments of brilliance for 2 to 3 months, and then just trade sideways after that. We have seen lots of momentum in gold since 2024. It's been exceptionally strong, and it's similar to what we just talked about, where anytime there's any kind of push to the downside, like breaking down underneath an obvious support level or an obvious moving average, it doesn't hold down there very long. It just continues to be scooped up. So gold technically is parabolic. You just slap a couple trend lines on over the past few years, and you can see that the trend lines have increased, right? That's how you make a parabola. It's the lines that go up. I think for me right now, silver is a better play, is a more speculative play. I do see how gold has, you could view it as some kind of a base, some kind of long continuation breakout setup, especially if it gets above 315. But I think silver and silver miners and actually the junior miners may be a better bet right now than trying to play the precious metal. If you're looking for more juice to squeeze out of this trade. Now, I could be wrong. The sucker could drop, 10% overnight. But part of part of the gold trade is the dollar trade, and the dollar has been weak. It's been an implicit policy of the federal government. But if you look at the dollar positioning right now, it's a very crowded trade. And so if the dollar sees some kind of a squeeze higher, is gold going to maintain its bid in dollar terms? There's also a really fun, I'm going to try and pull this up. Let's see. Gold. If you look at the money supply, now we're going to get in some stupid macro. All right. So we're just going to have some fun for a second. If you look at gold prices relative to the total money supply, which is M2SL, you can actually get some incredible levels that have longer term support and resistance implications. So we are coming back up to the 2011, 2012, what I guess we can call resistance levels, because we're looking at how much demand is there for gold relative to all money available, right? And so that just gives you that incremental liquidity, but on a longer term basis, right? So as the money supply expands, there's more money available, so it reduces the denominator in terms of dollars, and then gold goes higher. That's the basic idea. And so we are coming back up, once we get to, these don't even have levels because the denominator is so big. Once we get back up to those 2011, 2012 levels, it's probably not going to be an easy long anymore. And that's not that far away. And I know this is kind of a weird chart because everyone's just looking at GLD or they're looking at gold. But if you take it in the context of, some bigger macro perspectives, it actually works exceptionally well for longer term timing. So this is a fun one. And you can actually do the same thing with the Dow Jones. Like there's critical levels on the Dow Jones relative to the M2 that for whatever reason actually work really well.
Fascinating stuff. And Steve, before we wrap up, do you have any kind of final thoughts going into this week, what people should be, looking for? I mean, we've covered a lot. We've covered the oil market, commodities, some small cap potential runners. We've covered things with crypto, with relative strength, with payment processing. What do you have in the next 30 seconds to basically get people as ready as possible for the week ahead?
Okay, don't doom scroll. Don't try and enforce your moral opinions on what should be going on with geopolitics onto the market. Have a couple hypos, right? Saying if this happens, and this is probably going to happen, have your levels on crude, have your levels on the S&P, and you don't necessarily have to focus on the broad markets. There's a lot of individual plays that are still working, and until that stops working, you have to continue to play it.
100%. So yeah, thank you so much for coming on. I mean, we covered a lot. You shared your thoughts on so many markets, and I think it's going to really help people get prepared for the week ahead. So thanks for being on Sunday Scan, and we'll see you on X.
All right. My pleasure. Take care.
Thank you. Thank you everyone for watching. If you want to trade live alongside me and other members of the Investors Underground community, then check out investorsunderground.com to see if becoming a member is the right decision for you. They have some of the best technology and a lot of great members there, all looking to help other people improve their trading. And also check out Investors Underground content on YouTube and Twitter. Thank you.